Current live trading data for Supermicrocomputer Inc., ticker symbol SMCI, shows the stock trading at exactly $34.84 USD, up by $1.11, which is a positive move of 3.29% on the intraday session. While that green percentage might look like a standard recovery day to the casual observer, the reality sitting underneath this price action is far more volatile and consequential than a simple single-digit gain suggests. The expectation right now, the narrative that has dominated every financial news outlet and every Fidelity Investments newsletter for the last 3 weeks, was that Supermicrocomputer was effectively walking toward a guillotine. The market expected a delisting notification. They expected the Nasdaq to kick them off the exchange. They expected silence. But the reality we are seeing unfold in real time is a massive, violent pivot back to life, driven by a piece of news that many short sellers were betting would never come. This isn't just a stock ticking up. It is a company fighting for its corporate survival, and at least for today, landing a punch that has stunned the bears. Let's talk about what is actually happening, because if you were just looking at a line on a chart on your Robinhood app, you are missing 90% of the story. For months, the expectation was that Supermicro's accounting troubles were a bottomless pit. When their previous auditor, Ernst & Young, resigned in late October, they didn't just quit, they left with a letter that effectively said they could no longer rely on the representations of management. In the world of corporate finance and individual brokerage accounts, that is usually the death knell. It's the kind of signal that sends Fidelity Wealth Management advisors running for the exit. The stock collapsed from its highs, wiping out billions in market cap, and the consensus was that they would miss their filing deadline and be relegated to the pink sheets. But here is the contrarian reality that is fueling today's 3.29% move and the massive rally we saw earlier in the week. Supermicro found a new auditor. They hired BDO, a major global accounting firm, and they submitted a compliance plan to the Nasdaq just hours before the deadline. This singular act shifted the ground beneath the market's feet. It converted a guaranteed bankruptcy narrative into a turnaround play narrative almost overnight. This is why you are seeing this price action. It is the violent unwinding of fear. When SoFi Invest users and retail traders realize that the worst-case scenario, immediate delisting, has been taken off the table, the repricing is aggressive. The stock isn't moving up because their earnings suddenly tripled today. It is moving up because the immediate threat of execution has been stayed. However, we need to be very careful here. There is a massive difference between staying execution and being proven innocent. While the Robinhood stock trading forums are lighting up with rocket emojis, the institutional view, the view you might get if you were analyzing this through Interactive Brokers trading workstations, is much more cautious. The company still has to file their 10K, they still have to get BDO up to speed, and they still have a Department of Justice probe hanging over their heads like a sword of Damocles. To understand why this stock matters so much and why Tesla stock and Nvidia stock holders should be watching this like a hawk, you have to understand the ecosystem SMCI occupies. They are not just a boring box maker. They are the primary plumber for the AI economy. When you hear about Nvidia stocks soaring because of demand for the Blackwell chips, you have to ask, where do those chips go? They don't float in the cloud, they get slotted into massive, complex server racks. Supermicrocomputer builds those racks. They take the Lego blocks that Nvidia provides, and they build the castle. The reason this stock was a darling of Fidelity ETFs and growth investing sites earlier this year was their proprietary technology in direct liquid cooling, or DLC. This is the moat. Traditional data centers use air conditioning, giant fans blowing cold air on hot chips. But the new AI chips from Nvidia are so powerful and run so hot that air cooling is becoming physically impossible. You can't blow enough air on them without the data center sounding like a jet engine and costing a fortune in electricity. SMCI's liquid cooling technology pipes coolant directly over the chip, absorbing heat far more efficiently. This is where the connection to Tesla stock becomes critical. Elon Musk's XAI venture built a massive supercomputer cluster in Memphis known as Colossus. Who did they use to build a significant chunk of that infrastructure? Supermicrocomputer. When you see Tesla stock moving on AI news or Musk talking about Grok, that is effectively a downstream demand signal for Supermicrocomputer's hardware. The fact that they have customers like XAI and potential deep ties with other hyperscalers is why the bulls are willing to overlook the accounting mess. They look at the Fidelity Intelligent Portfolio's algorithms and see a company trading at a single-digit PE ratio with triple-digit growth. On paper, it looks like the deal of the century. But let's pause and look at the mechanics of this trade right now, because if you are using investing sites to make a decision based on today's price of 34.84, you are stepping into a minefield. The volume today is heavy, which means the battle is active. We are seeing a lot of Fidelity brokerage activity where institutional money is likely trying to figure out if BDO can actually sign off on the books. If BDO signs off, this stock could theoretically double from here, returning to its previous valuation multiples. If BDO finds the same problems that Ernst & Young found, the stock goes to single digits. It's a binary event. This is not the kind of steady compounder you put in your Fidelity IRAs and forget about for 30 years. This is a high-stakes arbitrage on corporate governance. I want you to take a second and look at your own portfolio strategy. Are you trading this momentum, or are you investing in the company? Comment below how many shares of Supermicro you currently hold, or if you sold during the panic drop to $18. I want to see where the sentiment is among real traders. Let's shift to the competitive landscape, because SMCI is not alone. They are fighting a war on two fronts, one against their own auditors and one against Dell and Hewlett-Packard Enterprise. While SMCI has been distracted trying to find an accountant, Dell has been aggressively stealing market share. Nvidia stock CEO Jensen Huang has notably appeared at Dell events recently, praising their ability to scale. If you are analyzing this sector using Interactive Brokers platform tools, you might notice that the order flow for Dell has been robust and steady, while SMCI has been chaotic. Dell is the safe pair of hands. They are the corporate standard. If you are a CIO at a Fortune 500 company and you need to order 1,000 AI servers, are you going to order from the company that might be delisted next week? Or are you going to order from Dell? That is the fundamental risk that no amount of Fidelity Mobile app alerts can quantify. The reputational damage might be causing a silent churn in their backlog that we won't see until the next earnings report. There is also a technical angle to today's price of 34.84. We are sitting right at a critical resistance level. The stock has bounced from the teens, but it is hitting a wall where all the people who bought in at $35 and $40 months ago are desperate to sell. This is called overhead supply. When you use SoFi Active Investing or similar platforms, you have to watch for these levels. There are thousands of investors who have been underwater for months praying for the stock to get back to $35 so they can break even and get out. That creates selling pressure. For the stock to break through $35 and run to $40 or $50, it needs overwhelming volume to absorb all that selling. We also need to discuss the Robinhood crypto and speculative money effect. A lot of the volume in SMCI recently has been driven by the options market. Retail traders are buying call options, betting on a squeeze. When market makers sell those calls, they have to hedge by buying the underlying stock. This creates a feedback loop, a gamma squeeze, which can send the stock ripping higher regardless of the fundamentals. But this works in reverse too. If the momentum stalls, those hedges get unwound, and the stock can flush lower instantly. It's the same mechanic we see often with Robinhood cash management users throwing capital at high beta volatility plays. Now consider the macro environment. The Federal Reserve's interest rate path matters here. High-growth, capital-intensive businesses like server manufacturing are sensitive to rates. They need to borrow money to build inventory. SoFi stocks analysis often overlooks working capital, but for SMCI, it is everything. They have to buy billions of dollars of chips from Nvidia before they get paid by their customers. That cash conversion cycle requires massive liquidity. With the accounting issues, their access to credit facilities could be tightened. If banks get nervous, they cut the credit lines. If credit lines are cut, SMCI can't buy chips. If they can't buy chips, revenue collapses. It is a fragile chain of dominoes. This is why investment help from professional advisors